For most of my career, people have called me a technology dinosaur. They said I didn't understand tech companies. They said I was missing out on the greatest wealth creation opportunity in history. And you know what? They were right about some of that. I did miss Microsoft in the early days, even though Bill Gates was my friend. I didn't buy Google when I should have. I passed on Amazon for years. Those were mistakes, and they cost Berkshire Hathaway hundreds of billions of dollars in potential gains. But here's what people don't understand. I wasn't avoiding technology because I'm old or stubborn or afraid of new things. I was avoiding it because I didn't understand how to value these companies. I couldn't predict with any confidence which tech companies would still be dominant in 10 or 20 years. And if I can't understand a business well enough to predict its future, I don't invest in it. That's been my rule for 70 years, and I'm not changing it now. However, something has changed in the technology world over the last decade, and a handful of tech companies have proven that they're not just flash-in-the-pan trends. They've built economic moats so wide and so deep that I can finally understand them the same way I understand Coca-Cola or American Express. They've become predictable, which is the highest compliment I can give any business. And in 2026, if someone put a gun to my head and forced me to pick just 2 technology stocks to own for the next 30 years, I would pick Apple and Amazon. Not Microsoft, not Google, not Meta, not any of the artificial intelligence darlings that everyone is chasing. Just those 2. And I'm going to explain exactly why, because the reasoning behind these choices will teach you more about investing than any list of stock picks ever could. Let me start with Apple, because Berkshire Hathaway already owns a massive position in this company. We started buying it back in 2016, and it's become one of the largest holdings in our portfolio. People were shocked when we did this. They said, "Warren, I thought you didn't invest in tech companies. What changed?" And my answer was simple. Apple isn't really a technology company anymore. It's a consumer products company that happens to use technology. Think about what Apple really sells. They don't sell phones or computers or tablets. Those are just physical objects. What Apple really sells is an ecosystem, a lifestyle, a sense of belonging to something premium and exclusive. When someone buys an iPhone, they're not just buying a device. They're buying into a system that includes their watch, their laptop, their tablet, their earbuds, their TV box, and dozens of services that all work together seamlessly. And here's the genius of what Apple has built. Once you're in their ecosystem, the cost of leaving is enormous. Not just financial cost, although switching everything you own to a different platform is expensive. I'm talking about the psychological cost. All your photos are in iCloud. All your messages are in iMessage. Your family is on FaceTime. Your music is in Apple Music. Your passwords are in your keychain. Your payment info is in Apple Pay. The idea of switching to something else is so overwhelming that most people never even consider it. That's what I call an economic moat, and it's the widest moat I've seen in any consumer products company. It's wider than Coca-Cola's moat, and I've been saying Coca-Cola had the best moat in the world for 50 years. But Apple's moat might actually be better because it's not just about brand loyalty. It's about ecosystem lock-in. Coca-Cola has to convince you to choose their product every single time you buy a soda. Apple only has to convince you once, and then you're in the system for decades. Let me give you some numbers so you understand just how powerful this business is. Apple has about 2 billion active devices in the world right now. 2 billion. That's roughly 1 device for every 4 people on the planet. And those aren't just devices sitting in drawers. These are active devices that people use every single day, multiple times per day. Your phone is probably the first thing you look at when you wake up and the last thing you look at before you sleep. Now, here's where it gets really interesting. Apple's revenue from services, things like iCloud storage, Apple Music, the App Store, Apple Care, and dozens of other subscriptions, is growing faster than their hardware revenue. In 2015, services were about 15% of Apple's revenue. Now it's over 25% and growing every year. By 2030, I wouldn't be surprised if services are 40% of their revenue. Why does that matter? Because services have much higher profit margins than hardware and their recurring revenue. When you sell someone an iPhone, that's a one-time purchase. But when you sell them iCloud storage at $10 per month, that's $10 every single month for years, probably decades. It's predictable, stable, high margin cash flow. That's the holy grail of business models. And Apple is just getting started with services. They're moving into healthcare with the Apple Watch. They're moving into financial services with Apple Pay and the Apple Card. They're moving into entertainment with Apple TV Plus. Every one of these services makes their ecosystem stickier and generates more recurring revenue. This isn't a company that's going to suddenly become irrelevant because some new technology comes along. They built something that gets stronger every year. Now, let me talk about valuation, because even a great company can be a bad investment if you pay too much for it. Apple trades at a price-to-earnings ratio of around 25 to 30, depending on when you're watching this. That's not cheap by traditional standards. Berkshire Hathaway trades at a PE of around 20. The overall market trades at about 20. So Apple is at a premium. But here's why I'm comfortable with that premium. Apple's earnings are incredibly stable and predictable. They're not going to drop by 50% in a recession like some tech companies might. They're not dependent on one product or one technology trend. They have a diversified revenue stream across hardware, services, and multiple product lines. And most importantly, they return enormous amounts of cash to shareholders through buybacks and dividends. Apple buys back about $90 billion worth of their own stock every year. Think about that for a second. $90 billion, that's more than the entire market cap of most companies. Every year, they're reducing their share count, which means that your ownership stake in the company becomes slightly more valuable, even if the stock price doesn't move. Over 10 or 20 years, that adds up to massive value creation for shareholders. And unlike most tech companies, Apple actually pays a dividend. It's not a huge dividend, less than 1% yield, but it's there and it grows every year. For me, that dividend is a signal that management is confident about the future. Companies that are worried about their future hoard cash. Companies that know they're going to keep printing money return cash to shareholders. Let me address the biggest concern people have about Apple, China. About 20% of Apple's revenue comes from China, and there's a real risk that geopolitical tensions could hurt that business. The Chinese government could decide to ban iPhones or make it much harder for Apple to operate there. So that's a legitimate worry, and I don't dismiss it. But here's my counter-argument. Apple has over 1,500 suppliers and manufacturers worldwide. They're not just a Chinese business or an American business. They're a global business with the scale and resources to adapt to changing political situations. If they need to move manufacturing, they will. It will be expensive and take time, but they can do it. And even if they lost all their China revenue tomorrow, which is extremely unlikely, they'd still be a massively profitable business with room to grow in India, Southeast Asia, Africa, and other developing markets. The other concern I hear is about iPhone sales growth. People say the smartphone market is saturated. Everyone who wants a phone already has one. Growth is slowing down. And that's all true. iPhone unit sales aren't going to double in the next 5 years. But that's okay, because Apple isn't just about selling more phones anymore. It's about selling more services to existing customers and gradually raising prices on premium products. Look at what happened with the iPhone over the last 10 years. The average selling price has gone from about $600 to well over $900 for the latest models. Some iPhone models cost over $1,000, and people are lining up to buy them. Apple has trained their customers to expect to pay premium prices, and those customers are willing to pay because the value is there. That pricing power is incredibly rare and incredibly valuable. Now let me talk about Amazon, which is a very different kind of company, but equally powerful in its own way. If Apple is about ecosystem lock-in and premium pricing, Amazon is about scale, efficiency, and becoming essential infrastructure for both consumers and businesses. I'll be honest with you, I underestimated Amazon for a long time. I watched Jeff Bezos build this company from an online bookstore into the everything store. And I kept thinking, where's the profit? How is he going to make money when he's spending every dollar on growth? I was wrong to think that way. Bezos was playing a much longer game than I understood, and that long game has paid off spectacularly. What Amazon has built is almost impossible to compete with at this point. They have the largest e-commerce platform in the Western world. They have the most sophisticated logistics and fulfillment network ever created. They have Amazon Web Services, which is the backbone of the modern internet. They have Prime Video, which is competing directly with Netflix and traditional TV. They have Alexa and smart home devices. They have Amazon Fresh and Whole Foods for groceries. They're even moving into healthcare and prescription drugs. But here's what makes Amazon truly special. All of these businesses reinforce each other. The more people shop on Amazon.com, the more data they have to improve their recommendations and logistics. The more sellers use their platform, the more products they can offer, and the more commissions they collect. The more companies use AWS for cloud computing, the more cash flow they generate to invest in everything else. It's a flywheel that gets stronger every time it spins. Let me focus on AWS for a minute, because this is the part of Amazon that most people don't fully understand. Amazon Web Services is essentially renting out computer power and storage to other companies. It's not sexy. It's not consumer-facing. Most people have never heard of it, but it generates about $80 billion in revenue per year with operating margins of around 30%. That's $24 billion in operating profit just from this one division. To put that in perspective, AWS alone generates more profit than most Fortune 500 companies generate in total revenue. And it's growing at 15 to 20% per year because every company in the world is moving to the cloud. Every startup, every enterprise, every government agency needs cloud infrastructure. And AWS is the market leader by a huge margin. They have more than twice the market share of their nearest competitor. Here's why that matters for Amazon's future. AWS generates the cash flow that allows Amazon to keep spending aggressively on their retail business, on new initiatives, on expansion. While other retailers are struggling to compete on thin margins, Amazon can afford to lose money or break even on retail because they're printing money with AWS. It's an unfair advantage that no other retailer has. And now we're seeing the same dynamic with advertising. Amazon's advertising business is already bigger than their AWS business in terms of revenue, generating close to $50 billion per year. When you search for a product on Amazon, those sponsored listings at the top, that's advertising. When brands want their products to show up first in search results, they pay Amazon. And because Amazon has all the purchase data, they can target ads better than anyone except maybe Google and Meta. Think about how powerful that is. Amazon knows what you bought in the past. They know what you're searching for right now. They know what's in your cart. They can target you with ads for products you're actually likely to buy at the exact moment you're ready to buy them. That's worth a fortune to advertisers. And Amazon is just beginning to tap into this revenue stream. Now let's talk about Amazon Prime, because this is the glue that holds everything together. Amazon has over 200 million Prime subscribers worldwide, paying between $100 and $150 per year for membership. That's over $20 billion in annual subscription revenue. But more importantly, Prime members spend way more money on Amazon than non-Prime members. They shop more frequently, they buy more products, and they're much less likely to shop anywhere else. Prime is another one of those ecosystem lock-in strategies, just like Apple's ecosystem. Once you're paying for Prime, you're incentivized to buy everything on Amazon to get your money's worth. You get free shipping, so you don't want to pay for shipping somewhere else. You get Prime Video, so you're less likely to subscribe to other streaming services. You get access to Prime Day deals. You get free grocery delivery in some markets. It's a constantly growing bundle of benefits that makes leaving Amazon harder every year. Here's something that really impresses me about Amazon. Their obsession with logistics and efficiency. They've spent decades building out a delivery network that can get products to your door in one day, sometimes the same day. They're using robots in their warehouses. They're experimenting with drone delivery. They're building their own airplane cargo fleet. They own their own trucks and delivery vans. They're even delivering packages themselves instead of just using UPS and FedEx. Why does all of that matter? Because logistics is the ultimate barrier to entry in e-commerce. Any company can build a website to sell products, but very few companies can deliver millions of products to millions of customers efficiently and profitably. Walmart has spent billions trying to compete with Amazon, and they're still way behind. Target, Best Buy, everyone else in retail is trying to figure out same-day delivery, and Amazon has been doing it for years. That's an economic moat. Not as sticky as Apple's ecosystem moat, but just as powerful in its own way. If you're a consumer, you shop on Amazon because they have everything and they deliver fast. If you're a seller, you sell on Amazon because that's where the customers are. And the more both sides use the platform, the more valuable it becomes. That's called a network effect. And it's one of the most powerful forces in business. Now let me talk about the risks with Amazon, because there are some real ones. The biggest risk is regulatory. Amazon is so big and so dominant that governments around the world are looking at breaking them up or regulating them more heavily. The European Union has been particularly aggressive about this. There's a real possibility that Amazon could be forced to separate AWS from their retail business, or that they could face restrictions on how they use seller data to compete with their own private label products. I'm not going to pretend that's not a risk. It is. But here's why I'm not terribly worried about it. Even if Amazon gets broken up into separate companies, those separate companies would probably be worth more in total than Amazon is worth today. AWS as a standalone company would be valued like a pure cloud computing business, which commands much higher multiples. The retail business without AWS dragging down margins would also be valued higher. So ironically, breaking up Amazon might actually create shareholder value. The other risk is competition, particularly from Chinese e-commerce companies like Temu and Shein that are trying to undercut Amazon on price. These companies can ship directly from China to consumers, cutting out middlemen and offering extremely low prices. That's a legitimate threat to some of Amazon's business, particularly in lower-priced goods. But here's my counter. Amazon isn't competing primarily on price anymore. They're competing on speed, selection, and convenience. Yes, you can buy some things cheaper on Temu if you're willing to wait 2 or 3 weeks for shipping and deal with uncertain quality. But if you want something tomorrow, or if you want to know you can return it easily if there's a problem, or if you want to read thousands of reviews from real customers, you go to Amazon. For most people, that convenience is worth paying a little more. Let me talk about valuation with Amazon, because this is where it gets interesting. Amazon trades at a PE ratio of around 35 to 40, which is expensive. It's more expensive than Apple, way more expensive than the overall market. On a traditional valuation basis, Amazon looks overpriced. But here's the thing about Amazon, their reported earnings significantly understate their true earning power because they reinvest so much money back into growth. If Amazon wanted to maximize short-term profits, they could easily double or triple their net income just by slowing down investment in new warehouses, new markets, new initiatives. But Bezos built a culture of long-term thinking, and the current management team has maintained that. I look at Amazon's free cash flow instead of reported earnings, and on a free cash flow basis, the valuation is much more reasonable. They generate about $50 to $60 billion in free cash flow per year, and that number is growing. In 5 years, it could easily be $100 billion. In 10 years, it could be $200 billion. When you think about it that way, paying today's price for Amazon starts to look pretty smart. Here's why I would pick these two stocks over all the other tech companies out there. Microsoft is a great company, probably the best run tech company in the world right now, but their moat comes primarily from business software and enterprise contracts, and those relationships can change over time. Google has an incredible search monopoly, but that monopoly is under attack from regulators and from new AI technologies that might change how people find information. Meta owns social networking, but social networks come and go, and younger generations are already moving away from Facebook and Instagram. Apple and Amazon are different. They're not dependent on a single technology or trend. They built themselves into the fabric of daily life for billions of people. Apple is how you communicate, how you pay for things, how you entertain yourself, how you track your health. Amazon is how you shop, how you watch TV, how businesses run their technology, how products get from manufacturers to your doorstep. These aren't fads. These are fundamental changes in how society operates. And both companies are run by management teams that think long-term. Tim Cook at Apple has done an incredible job transitioning the company from the Steve Jobs era. He's more pragmatic, more focused on operations and services. And under his leadership, Apple has become more profitable than ever. Andy Jassy at Amazon took over from Bezos and has maintained the same long-term focus while also improving profitability. Both of these leaders understand that you don't maximize value by chasing quarterly earnings. You maximize value by building something that gets stronger over decades. Here's something else that's important. Both of these companies have fortress balance sheets. Apple has about $60 billion in net cash. Amazon has over $80 billion in cash and investments. They don't need to borrow money. They're not dependent on the credit markets. They can weather any recession, any crisis, any unexpected shock. When times get tough, they'll keep investing while their competitors are cutting back, and they'll come out the other side even stronger. Let me tell you what I would do if I were a young person starting to invest today. I would put 50% of my money in an S&P 500 index fund, because that's the foundation of any good portfolio. Then I would put 25% in Apple and 25% in Amazon, and I would hold all three forever. That's it. 3 investments. No trading, no market timing, no trying to find the next big thing. Just own these 3 things and get on with your life. Over 30 or 40 years, I'm confident that portfolio would beat 99% of actively managed portfolios. It would beat most hedge funds. It would beat most professional investors. Not because I'm smarter than everyone else, but because these are businesses that have every advantage in the world. And compound interest is the most powerful force in investing. Now, I know some of you are thinking, but Warren, what about artificial intelligence? What about all these new AI companies that are going to change the world? Shouldn't I be investing in those instead? And here's my answer. Maybe some of those AI companies will be huge. Maybe NVIDIA continues to dominate. Maybe OpenAI becomes the next Google. Maybe some company that doesn't exist yet becomes the AI leader. I don't know, and neither do you. But here's what I do know. Apple and Amazon will both benefit enormously from AI, regardless of who wins the AI race. Apple is already integrating AI into all their products and services. Siri is getting better. Their photo organization uses AI. Their health monitoring uses AI. They're going to be buying AI capabilities from whoever builds the best ones, and they have the cash and scale to do it better than anyone. Amazon is the same way. AWS is the infrastructure that most AI companies run on. Amazon's logistics uses AI for routing and optimization. Their advertising uses AI for targeting. Their recommendation engine is AI. They don't need to invent the best AI models. They just need to implement AI everywhere in their business, which they're already doing. So buying Apple and Amazon is a way to invest in AI without trying to pick which specific AI company is going to win. Let me give you one final thought about why these 2 stocks are special. Both Apple and Amazon have proven that they can evolve. Apple started as a computer company, then became a music company with the iPod, then became a phone company with the iPhone. Now they're becoming a services company. At each stage, they reinvented themselves while keeping customers in their ecosystem. Amazon started as a bookstore, became an everything store, then became a cloud computing company. Now they're becoming an advertising company and a logistics company and a healthcare company. They keep expanding into new areas while using their core strengths to dominate each new market they enter. That ability to evolve is incredibly rare. Most companies get disrupted because they can't or won't change. Kodak couldn't evolve from film to digital. Blockbuster couldn't evolve to streaming. Sears couldn't evolve to e-commerce. But Apple and Amazon have shown over decades that they can adapt to whatever the future brings. That's the ultimate competitive advantage, and it's why I'm comfortable betting on them for the next 30 years. Now, let me give you some practical advice about how to actually invest in these two companies, because knowing what to buy is only half the battle. The other half is knowing how to buy it and more importantly, how to hold it through the inevitable ups and downs. First, don't try to time your entry. Don't wait for a crash or a pullback or what you think is the perfect moment. If you believe these are great companies, and I've just spent the last hour explaining why they are, then the best time to buy is now. The second best time is tomorrow. The worst thing you can do is wait for some perfect moment that never comes while these companies keep growing and compounding. I've seen this mistake 1,000 times. Someone decides they want to invest in a great company, but they think it's a little expensive, so they wait for it to drop. Then it doesn't drop, it goes up. So they wait more, thinking surely it will come back down. Then it goes up more. Eventually, either they buy at a much higher price than they would have paid originally, or they never buy at all and watch from the sidelines while they could have been making money. The reality is that great companies usually look expensive. That's because other investors recognize they're great, so there's always demand for the stock. Apple has looked expensive for the last 10 years, and it's gone up 5 or 6 times anyway. Amazon has looked expensive for 15 years, and it's gone up 20 times. If you wait for these companies to look cheap, you're going to wait forever. Second, if you don't have enough money to buy meaningful positions in both companies right now, to set up a plan to dollar cost average into them over time. Maybe invest $500 per month, split between the two, or $1,000. Whatever amount you can afford without impacting your ability to live your life. The key is consistency and discipline. Don't try to get clever by buying more when you think they're low and less when you think they're high. Just invest the same amount every month, regardless of price. This approach, which I call automatic investing, removes emotion from the equation. You're not making a decision every month about whether to invest or not. You've already made that decision once, and now you're just executing the plan. This is incredibly powerful psychologically because it prevents you from doing stupid things like selling in a panic or trying to time the market. Let me tell you what's going to happen after you buy these stocks. At some point, probably within the first year or two, both of them are going to drop 20 or 30% or maybe more. There will be a recession or a market correction or some crisis that nobody saw coming. Your account balance is going to go down significantly. You're going to feel sick to your stomach. You're going to question whether you made a mistake. Do not sell. I'm going to say that in all caps in my mind. Do not sell. When great companies drop in price for reasons that have nothing to do with their fundamental business, that's when you should be buying more, not selling. Every single time the stock market has crashed in history, it has eventually recovered and gone higher. Every single time. The only people who lost money permanently were the ones who sold during the crash. Think about it this way. If you owned a rental property that generated $10,000 per year in income, and someone offered to buy it from you for 30% less than you paid for it, would you sell? Of course not. You'd recognize that the offer is stupid and your property is still generating the same income it always did. The same logic applies to stocks. Apple and Amazon will still be selling products and making money regardless of what their stock price does in the short term. Here's another thing that's going to happen. You're going to hear about the next hot stock. Some new company that's growing faster than Apple or Amazon. Some exciting technology that's going to change everything. AI, quantum computing, biotechnology, whatever the trend of the moment is. And you're going to be tempted to sell your boring, stable positions in Apple and Amazon to chase that excitement. Don't do it. I watch brilliant people destroy their wealth by constantly chasing the next big thing. They sell their winners to buy lottery tickets, and they end up with nothing. The grass always looks greener somewhere else, but the reality is that finding companies as good as Apple and Amazon is incredibly rare. When you own them, hold on to them. Don't get cute. Don't try to trade in and out. Just hold them. And let me tell you about a concept called opportunity cost, because this is something that trips up a lot of investors. Opportunity cost is what you give up by choosing one investment over another. If you buy Apple and it goes up 20%, but some other stock goes up 50%, you might feel like you lost money, even though you actually made money. That feeling can lead you to make bad decisions. The truth is, you can't own every stock. You can't catch every big winner. You're going to miss things, and that's okay. The goal isn't to make the absolute maximum possible return. The goal is to make a very good return with very low risk of permanent loss. Apple and Amazon give you that. They're not going to be the fastest growing stocks every year, but they're going to compound steadily over decades, and that's what matters. I want to talk about something that doesn't get discussed enough, the psychological benefit of owning businesses you understand and believe in. When you own Apple and Amazon, you interact with these companies every single day. You use your iPhone, you shop on Amazon, you see their products everywhere, you understand why people love them. That familiarity gives you confidence to hold through the inevitable downturns. Compare that to owning some obscure company in a business you don't understand. When that stock drops, you have no idea if it's because something fundamentally changed with the business or if it's just market noise. You don't have the confidence to hold or the knowledge to know if you should sell. That uncertainty leads to bad decisions. With Apple and Amazon, you can look around at the real world and see that people are still using iPhones and still shopping on Amazon, and that gives you the conviction to stay invested. Here's something else I want you to think about. The power of doing nothing. In investing, doing nothing is actually doing something. Every day you hold a great company, you're benefiting from their growth, their innovation, their expansion into new markets. You're collecting your share of their profits through appreciation and buybacks and dividends. The returns compound without you having to do anything at all. Most investors hurt themselves by doing too much. They trade constantly. They try to optimize every decision. They spend hours researching new investments when they should just be holding what they already own. All that activity creates transaction costs, tax costs, and most importantly, it leads to mistakes. The best investors I know do very little. They find great companies and sit on them for decades. Let me give you a thought experiment. Imagine you bought Apple and Amazon today and then you went into a coma for 20 years. When you woke up, what would have happened? Well, assuming both companies continue to exist and remain dominant, which I believe they will, your investment would probably be worth 5 or 10 times what you paid for it, maybe more, all without you doing anything. You didn't have to monitor the stock price. You didn't have to read quarterly earnings reports. You didn't have to make any decisions. You just own great businesses and let time do its work. Now compare that to the alternative. You stay awake and active for those 20 years. You check your stocks every day. You read every news article about them. You watch CNBC. You listen to analysts. You get scared during downturns and sell. You get excited during rallies and buy more. You see other opportunities and switch your money around. What are the chances you do better than the person who was in a coma? Based on decades of data about investor behavior, the chances are you do worse, much worse. That's the tragedy of active investing. People think they're helping themselves by staying involved, but they're actually hurting themselves. The human brain is not wired for investing. We're wired to respond to immediate threats and opportunities. We're emotional creatures. We get scared when things go down and greedy when things go up. Those instincts served us well when we were hunters and gatherers, but they destroy wealth in the stock market. The solution is to make one good decision, buying great companies, and then do nothing. Protect yourself from yourself. Don't give yourself the opportunity to make emotional decisions. Set it and forget it. That's not laziness, that's wisdom. Now let me address one more thing before I wrap this up. Taxes. A lot of people don't think about taxes when they invest, and that's a huge mistake. Taxes can destroy your returns if you're not careful. Every time you sell a stock that's gone up, you owe capital gains tax on the profit. If you held it less than a year, you pay ordinary income tax rates, which could be 30 or 40%. If you held it more than a year, you pay long-term capital gains rates, which are lower but still significant. But here's the beautiful thing. If you never sell, you never pay those taxes. The money that would have gone to the government stays in your account, continuing to compound. This is one of the most powerful wealth-building strategies that exists, and most people ignore it. They trade constantly, generating tax bills every year, giving away a huge chunk of their returns to the IRS. With Apple and Amazon, my plan is simple. Buy them and never sell them, ever. When I die, my heirs will inherit them at a stepped-up cost basis, meaning they won't owe taxes on all the gains that accumulated during my lifetime. That's perfectly legal. And it's how generational wealth is built. You find great assets, you hold them forever, and you pass them on to the next generation. That's it. That's the whole strategy. I know this approach sounds too simple to work. People want complexity. They want sophisticated strategies and clever tactics. But I've been doing this for 70 years, and I'm telling you, simple is better. Find great companies, buy them, hold them forever, don't pay unnecessary taxes, and let compound interest do its magic. That's how you get wealthy in the stock market. So if someone forced me to pick just 2 tech stocks for 2026 and beyond, it would be Apple and Amazon. Not because they're going to double next year or because they're the most exciting stories in tech, but because they've built businesses that are so strong, so diversified, so embedded in daily life that I can't imagine a future where they're not massively valuable. And in investing, that's all that really matters. Buy them today, hold them for decades, ignore the noise, and thank me in 30 years when you're looking at returns that beat almost everything else you could have invested in. That's my advice, and it's the same advice I'd give to my own grandchildren.